got less than 10 minutes until this week is over and done. Let's talk some sectors, maybe some stocks with Jim Lowell joining us, CIO at Adviser Investments. Jim, welcome to the show this afternoon. I want to jump straight into it. I teased some stock picks, but you've got some sector picks, maybe more broadly, which works too. What do you like right now?
Well, it's an excellent question, Oliver. This is a market that's effectively still being priced to perfection with a lot of stimulus wind behind its back and maybe more wind if the infrastructure deal comes down the pike. So we wouldn't take our eye off the risk radar screen. We know that COVID's behaving more like COVID, China behaving more like China. Those are just two of the risks that we see on the screen. But doesn't mean there aren't opportunities. We think healthcare in particular is a sector that has trailed a little bit in terms of performance so far this year, but over any meaningful long-term timeline, healthcare has been able to deliver a brilliant risk-adjusted return. So we think that's a sector that absolutely investors ought to be paying attention to, and we tend to be overweight the healthcare sector inside of our more diversified portfolios.
Okay.
We understand that technology up here, and of course in China, has been taking it on the chin. But we think that long-term, even intermediate-term technology, both domestic and global, is an area for more aggressive growth investors to pay attention to.
Jim, I like the healthcare point because it has gone a little bit overlooked as the focus in healthcare was so specifically on the COVID crisis, obviously rightly so over the past year. But this sector now is starting to pick up the pace. We've had a really great month and a half where healthcare has really woken up and has been jamming. Within this group, can you give me some details? Is it just broad sector exposure, demographic play of folks getting older and needing medical care, or is this about more high growth biotech that has proven itself to be a really incredible resource as we break some new ground on many fronts?
I'd say it's all that and then some, Oliver. So medical equipment and systems, HMOs, major pharmas, biotech, you name it. I think there are, certainly in the hands of a good active manager and a good no-load mutual fund, investors would be able to really reap the benefits of what's been a very sort of short-term, we think, downturn relative to the broader market. They're down for the year. We also think that investors need to cast their eye globally, even though China is difficult to do so in terms of China region. And of course, what's going on with the Delta variant inside Europe, travel restrictions, et cetera, make Europe a place that probably investors are not thinking of looking at all that closely, but they ought to. We think selective stock picking in the established markets of Europe, in emerging markets, in China region, and China itself, maybe outside of the technology sector in particular with regard to China's marketplace, makes considerable sense for long-term investors like us.
You mentioned the tech companies too, Jim. One of the points I see in your notes is battleship balance sheets, companies in the blue chip category that can grow their dividend. How do you define that broadly speaking today? Does it include, more specifically, I guess I should ask, those super cap FANG companies who just gave us earnings, with the exception of Alphabet? They weren't good enough, apparently. Nobody really bought these stocks after the report, as amazing as they are.
A lot of buying on rumors and hopes and selling on the news, even if the news was good. But we think that noise sorts itself out on a going forward basis. And the reality is the technology is completely ubiquitous. You can't even brush your teeth in the morning without using technology these days. So, but you need to pay attention to valuation. We definitely think you need to pay attention to quality, hence that battleship balance sheet, blue chip dividend growers. Not a time to simply think that buying the market is the best way to go. We think there are too many attendant risks that you get in that basket. We'd much prefer active managers with a long track record of managing through bull, bear, and different markets, running concentrated portfolios of higher quality names. We think that the push towards lower quality, certainly the rush into lower quality names in the technology sector, for example, and elsewhere in the bond market too, for that matter. While it may feel good on any given day, typically over the long run, quality is going to win out. So we wouldn't overlook that fact.
Okay. Jim, thanks for the analysis here. I really like the details on the healthcare sector in particular, as that group has been overshadowed, reminding us to put it on our radar. Thanks a lot, Jim. Have a great weekend.
You too, Oliver.
Yes, sir. Jim Lowell is the CIO at Adviser Investments.